Hello and welcome to the Leadership in Insurance podcast, otherwise known as the LiiP. I'm your host, Alex Bond, and I'm lucky to be joined by David Hughes of Mulberry Risk. Mulberry Risk operates in the kind of analytics space, providing services and products to the MGA market ostensibly. And welcome, David.
Oh, thanks, Alex. It's great. It's great to be here, actually.
No, thanks for doing this, and I appreciate you were talk us through your background, because that Mulberry Risk sign is hiding some delights.
yeah. This is just as we're all in lockdown and make compromises. This is the bedroom above my garage, and the Mulberry Risk sign is actually hiding a shower. So a little secret there.
I'm only picking you because that's the most professional background anyone's turned up with yet, and I love the fact it's hiding a shower. But look, thank you again for coming. The purpose of this is obviously to talk about leadership in insurance, and I wanted to start kind of by just talking about your route into insurance, because the absolute theme of the podcast so far has been that people don't tend to have these sort of linear progressions when they end up in these entrepreneurial type environments. Just going through your sort of CV, it's kind of quite the hit list of names of the insurance market: Beazley, Navigators, AIG, Chartist, Marsh, Barnett, Waddington. But you started out as an actuary. Is that the sort of career path?
Yeah, actually, one thing I not many people know is I started in pensions. When I graduated, moved to Cardiff, had a professional contract with rugby club in Cardiff, which didn't last very long. Didn't like playing professional rugby.
Really?
No. Well, is that the era when rugby just turned professional? So you're getting sort of £20 a game, and
right.
And you weren't allowed to turn up with a hangover. So that didn't last very long. But I started off in pensions consultancy as a trainee actuary. And it took me a couple of years before I ended up working probably for someone who's had a huge influence on my career. And I've just forgotten his name, actually.
We'll have to edit it in.
Yeah, we'll have to edit it in. No, Stephen. It is a Stephen. And he won't forgive me for getting his surname. But Stephen was chief actuary of Ace Global Markets, which at the time was the largest. They'd aggregated a load of syndicates together, and I joined Stephen as his chief actuary. No, he was the chief actuary. I joined him as an analyst, and he got me back in. I'd given up the exams. He got me back into taking the exams, convinced me to take the American route, actually, the Casualty Actuarial Society, which are very strong, focused technical exams on just general insurance. Whereas the UK was still heavily at the time pensions and life focused. During that process, the 3.5 years I was at Ace, Ace bought the Tarquin agency, which was John Charman's business. So I had the pleasure of working with John for a little bit on a number of projects. I had the parts of John team I met, and it's my first. I was born in Plymouth, or brought up in Plymouth, and to come into the city world and meet with someone who's as phenomenally successful as John Charman was a real eye opener for me. And at that moment, that was quite a key thing to work with John, because I just went, wow, I want to have my own business one day. And it just planted that seed. And this was back in '98, I think. And then I followed a girl to New Zealand, did some work in New Zealand, came back, and I joined Beazley as a pricing actuary in the specialty lines under Adrian Cox. And that was just terrific. I mean, if there's one thing about Beazley, a lot of the people are still there, which is a credit to that organization. They probably are a company that I still would like to model Mulberry on. Because I think everything they touched was just quality, and they have their problems like anyone, but I think their professionalism, the way they conduct themselves, is just really outstanding, And I didn't know him, but whilst I was there, Andrew Beazley was still alive and at Beazley, running it, and his ethos of the business which was really create a high caliber business which looks after its employees, which I believe is still instilled in the business today.
Oh yeah, 100%. I mean, from my perspective as someone that works in the recruitment industry for insurance, I mean, Beazley people are always very, very strong. You know, they hire very, very well. They look after their people. My friend Miria works there at the internal team, and I know that, you know, that there could be harder jobs getting people in. I'm not saying she doesn't work hard; she'll be very upset. But what I mean is, it's a name that carries cachet, because I think, yeah, it's well known how good their people are. You know, they have some of the best people in the market, and they do look after them. And I find it frustrating how simple that's, you know, that model is. It's like, get the best people, look after them. You know, even little things like that. I know they get their lunches and the travel paid for because they say, well, we pay you this and we want you to, you know, earn that. It's very simple, but then it's very difficult to do. You know, keeping people happy is a challenge.
It comes from the leadership, and I think it also means that they have to make really hard decisions. And Beazley are not scared of making difficult decisions. So, and a lot of the, you know, and I left Beazley to join Navigators as their international chief actuary. And these were the days when you could actually be a chief actuary without being qualified, because I'm not qualified. That's another story there.
We're letting all the secrets out now.
Oh yeah. It's like you're opening the sign behind the shower.
I was going to say the skeletons in the shower are coming out.
But no, so yeah, and Navigators was a whole different business. It was a great learning experience, working for the finance director Tracy Lillington there, and again another stage. But then I left Navigators and joined AIG. I wanted to move out of the Lloyd's environment and into the big company environment. And AIG was 2 years after the crisis hit, and on my first 2 weeks of working at AIG. My boss was Sarah Maillet, who became CFO of Europe, and I was head of capital management. It was just incredible. It was a company, and where I think in part of your induction process, I got introduced to the commercial lines director, and Jason, who's the commercial lines director, who's now the CEO over at QBE International, he said something which always stuck with me at my time at AIG, which is, this is an environment where you can create your career. This is an environment where there are no boundaries about how far you can go. AIG support that, and AIG sometimes is a bit of a madhouse, but it was full of incredibly talented people. And over the years since then, a lot of those talented people have left, and you'll see them that AIG, former senior people in AIG are littered throughout the industry in senior roles guiding it, and it's just, you know, Jason Harris at QBE, you've got Kelly Lyles, who I think is still at AXA XL. There are just these individuals who are really high caliber people. The team that went on to set up Berkshire Specialty, and you know, it's just incredible experience at AIG. Moving into Marsh, Marsh was probably a step back for me. So I moved out more into sort of portfolio management underwriting role at AIG towards the end there. I had a role working with Jim Shea at Global Specialty Lines, overlooking these portfolios. But then moving to Marsh was a step back into the analytics actuarial area. But that was working in a broker world. Directly with clients.
Yeah, why did you make that decision then? Because that's popped up a few times before, people not being scared to kind of take sideways or backward steps to go forward. What was behind that sort of decision process?
Part of it was Marsh offered me quite a bit more money.
Fair enough.
Had a young family. I was doing a lot of travel with AIG, and this was a lot less travel. But also it was to work in a broker environment. It was a great opportunity to build a team, a really good opportunity to be much more frontline, and that was a really big learning experience for me. One of the things that I realized I brought to the table was my international experience of being able to run meetings internationally, even just over a telephone call. We had one client, it was a steel client, and we had people dialing in from Argentina, someone from Hong Kong, someone from Africa, and AIG had given me the skills to be able to handle that effortlessly, and do a PowerPoint presentation over a phone. I mean, and
come in handy now.
It comes in very handy now. AIG gave me some of the groundings, but Marsh got me really close to clients. Whereas AIG, when you're looking at all this, you're quite a long way away. But with Marsh, we're right there. You could ask for data. We're getting some of the information from our clients to help them on understanding their risk and how it fits in their captive, and it's really rich data. Moving forward from that, I joined Barnett Waddingham, and it was at that point I was looking to set up my own firm.
Right.
And then Barnett Waddingham asked me to come and help them launch their London market GI practice. I did that for a short time, and then that's when I decided to launch Mulberry Risk. And ideally, I wanted to set up my own MGA because I saw this opportunity to get into that kind of insurtech space. And use analytics to really drive underwriting. But at the time, there was just so many MGAs being created. I realized I didn't really have skills. I'd found some capacity. And then it's at that point I was introduced to a chap called Guy Fraser. And you'll see there's a couple of people I've mentioned here. I've been critical. And Guy Fraser is one of those people in my stepping stone of where I am today, who's quite key in that stepping process. So Guy's he was a former AIG underwriter, motor fleet, and he set up Century Underwriting. Back in, crikey, when was it? 2000. Apologies, Guy, if you listen to this. I think it was 2013. I should know, or 12. He set it up, and they'd lost their capacity at then 2016, and they'd grown the book. It's a good business. The underwriting had been a little bit challenging in terms of their loss ratios, but I worked with Guy. I brought in a lot of the actuarial disciplines with him. I joined him as his acting chief operations officer for 6 months, just as we were searching for new capacity and embedding that into the business. And it was through that process, working with Guy, I really got to understand MGAs, but also I could see the value that I could bring to an MGA. And it was around really allowing them to have access to these skills, which are really the reserve of the big insurers, i.e. the actuarial skills, the data, the portfolio management. And if you bring that in and combine that with the really strong underwriting at someone like Century, you then create a really powerful business. But the problem is to get those skills, an actuary isn't cheap. And it's a significant investment for most MGAs, and particularly ones who've got 5 to 15 million pounds of GWP going through. It's a really hard to justify that kind of 6-figure plus salary. Of course. To bring that almost a non-producing individual on. So I set up Mulberry Risk on that basis to actually really, was my first pivot in the business, to really provide actuarial services and data analytics into niche insurance businesses. And so we started moving on that basis. Took my first employee on back in September 2018, and we grew, and then we really narrowed down on that focus to really focus on MGAs. We got pulled into a couple of insurer things, but now we're 100% focused on MGAs. We've worked on well over 40 MGAs annually. We've got some really we've got insurtech clients in there. One of them is top of the list, the insurtech list, has grown rapidly, and we're very, very proud of having them as a client. We've got 2 large MGAs, London market MGAs as clients, and then we've got some really small ones as well. One of my favorites is a business been going back 5 years, about 5 or 6 million pounds of premium goes through it. Young lad who runs it, and brilliant team around him, and they're just so entrepreneurial. There really are. The speed that they can do things and achieve things is just brilliant. The innovation that they can generate, the deals that they can get done. So, no, we provide these services.
Sorry to
into
interrupt.
MGAs, yeah.
Is that what you like about it? Because I think from someone who's entrepreneur himself, and obviously I've got my own business, I like the MGA model. I look at that and I probably had the same thought process as you. I thought, well, I could bring some talent together. Maybe I could do an MGA. And then I was like, no, I really can't. But I love the model, and I like the entrepreneurial nature of it. So is that kind of part of the appeal against, because one would imagine it might be potentially more profitable working with some of the bigger entities. Is some of the appeal working with these kind of more entrepreneurial, more nimble business units?
Yeah, definitely. We're right in the middle at the moment of about to launch our own insurance commercial lines pricing platform, which is to help MGAs replace their spreadsheets with a professional cloud-based pricing platform, which will have all kinds of wonderful things in it. And we're not building this fully by ourselves. We're working with a third party, and traditionally they've been working with insurers, and their lead time is probably 18 months or so to get a deal across the line.
Really?
And they're just sitting back going, wow, we can't believe the speed MGAs move at. And one of the reasons, and particularly the smaller ones, is because you're dealing with the operator owner.
Yeah.
You meet them, have a quick chat, and they say, do you know what, this is exactly what I need, handshake, the contract's signed next day, or thereabouts. It's a very quick decision-making process. There's no committees, and you get things done. They're really keen. That also comes down with downsides, because there's an expectation of delivery as well. So it's a much faster, and it's much faster business. And one of the things that we've had to do is, we've got some expensive resources in the company, and we're currently looking to grow. So if there are any actuaries and analytical people listening to this, please get in touch. But
via me.
What? Oh yeah, I forgot you're a recruiter. So one of the challenges we have is how can we make these services available to our clients at an affordable price and efficiently done as well. So what I didn't want is, having worked at a number of consultancies before, was I don't want to be scaling limited to people. So if we want to take someone on, then we have to bring some more hires on. Now, there is a bit we have to do that. All businesses have to do that. But can we actually create digital processes that are completely scalable?
Yeah.
And so if we double the amount of clients we have, maybe we only need to increase our headcount by 10%.
Yeah.
Get that non-linear relationship, and really leverage technology. And so that's what we've worked a lot on.
So is that where you're sort of building products versus offering services? Because I think that's what I'm seeing. I mean, that seems to be the trend of service industries now, is packaging things up that you can kind of take. And I think particularly in the analytics space, because as you rightly touched on, I mean, not wanting to bring COVID up, but you're replacing spreadsheets. There's a few places that spreadsheets could do with being replaced at the moment. Sometimes you're dealing with companies that have got no tools. So a off-the-shelf tool that is offering them a better sort of pricing model is much better than nothing. And then. Yeah, I mean, it's a trend I'm seeing. People are sort of generating products that people can buy and sort of take that off the shelf, and that makes it much easier for a business to grow. Whereas services, you're completely reliant on the number of people that you've got, the physical hands you have.
Yeah, so we're trying to do a quasi model. We're trying to, but we have productized what we're offering. So we do. I mean, yeah, it's always hard. Are we an actuarial consultancy? I suppose I don't fully like to say we are. We're an MGA consultancy.
Yeah,
we're focused on that, and we're building out more and more services around that. Now, we have a lot of actuarial know-how and expertise that we that we deploy at our MGAs and we have some non-MGA clients, but very limited. But you know, we focus on what is it an MGA needs. Now, one of the biggest risks that an MGA has is losing their capacity, that binder agreement they get from the insurer. So we had a couple of issues with one of a major client. It all went a bit pear-shaped, but these things happen. And I sat down and we lost the client, and I sat down over a weekend, locked myself away with a couple of bottles of red wine, and really got thinking, what is it that we're trying to do for our clients? What is it they need? They're not like an insurer who has to do reserving forecasts. They have to bring in actuaries on a regulatory basis. That's not us. What is it we're trying to do? Well, we're actually trying to help the MGA strengthen that relationship between them and their insurer. And why do you want to do that? Well, you do that because you want to protect that capacity agreement. And if you can protect that capacity agreement, then that's better for the insurer, because they're going to get an MGA they can rely on, who can produce results for them, and they're very happy to delegate the authority down. And for the MGA, it gives them security, massive security, because once you lose that binding authority, that can destroy your business. And we've seen that unravel in a number of MGAs in the market recently. So
I was going to say, is that something you're seeing more of recently because of the rate rises, and so people are sort of adopting the approach of bringing, keeping that capacity to themselves and bringing it in-house? Or
no, there's a number of things. I mean, we're seeing with there's a lot of action taken at Lloyd's. Lloyd's is a big provider of capacity to MGAs and delegated underwriting authority. Decile 10 activity, which was launched 2 years ago, is causing some issues. We are seeing issues with rate increases. So a number of your traditional markets in Lloyd's who underwrite MGAs have hit their upper premium boundaries now. So that's putting them under pressure. But it's also just MGAs are just getting a bit of a bad rap. And one of the reasons is because there is an expense to running on the MGA, and it's almost like a double count of expense. There's quite a few haven't performed in underwriting, but actually, I think you can argue that a number of insurers haven't performed as well, because that's where the market rates have been. You can't have MGAs performed in line with markets. Probably a lot of them have. There are a number which haven't, and but that's the state. So we try to help. Well, we help our MGAs get some of the procedures and benefits of actuarial input. We have our own minimum underwriting standards, which are heavily based on the Lloyd's ones, but just tweaked for an MGA. What makes it relevant to them? So we're kind of trying to put some of these gold standards which come out of Lloyd's and reduce the bureaucracy around that, and help embed that to our Mulberry MGA, and which will, with the whole benefit of really strengthening that capacity. And going back to your service versus product, well, we call this product capacity protector, because it does what it says on the tin, helps protect. And we keep it, we keep reviewing this. How can we improve it? How can we improve that proposition for the MGAs? How can we keep developing that protection? So that's certainly been the big challenge of the market, and timing for us has been pretty good on that. Just at this time when MGAs do need the services.
Because I mean, reputationally, it's a really interesting one. I mean, I like the model, and if anyone's got the kind of the books that people tend to be looking to back at the moment in MGAs, and short tail niche products, that seems to be the focus of everyone's looking for. I always run it past as an idea if someone's looking, and you still get some people to go, Lloyd's first, company market second, MGAs is a distant third, and they get a bit of a bad rap. But I think unfairly so, because I think, as you rightly said, I think there's a big exposure if an MGA performs poorly, it's very highlighted because it's a standalone business. Whereas if you're a division within a massive insurer and you've got poor results, we might know, but it's probably not as exposed, because I think there's a wealth of opportunities, certainly at the moment, with the technology services like yours, to really build a kind of first-class MGA.
Yeah, you're right. There's, oh God, you mentioned loads of things there, Alex, which are particularly interesting and relevant to today. So I'll take the first thing, which is about the large company and capital. So an insurer is about capital, managing the capital on the balance sheet. And as part of my job at AIG. So part of this is, where do you deploy that capital to get the optimum return? So every company which has got assets to deploy to get a return on has to look at that. Now, say you're sitting at AIG and you're going, right, I've got this business line over here. They've got 200 million and all the numbers. It's one of the things that took me a little while when I left AIG, was to get used to smaller numbers. And it was like, there's 200 million in this product line over there. And that's supported by this amount of capital. We're not getting the return. So let's cut that. Or let's reduce it by 50%. Well, your fixed expenses are so significant that doesn't really solve anything. So you're kind of stuck into this volume play. And even if you have got the volume play, you can't, even if you let people go, you've still got 6-9 months of cost. And now, if you were to take the same position with an MGA, you just give them 30 days notice and say, we've cut your capacity. And you haven't got you've got the overhead of the liabilities you've underwritten, but you can handle those in a different way, portfolio transfers and stuff. But actually, your fixed cost, your expenses are completely variable with that business. And as you say, also your performance management is much more specific. And so, you're seeing a number of businesses pop up which are just looking to manage capital, and work with MGAs, and deploy that capital. And the great thing you always want to do when head of capital management, which are reports to Treasury or the CFO, they're always looking to make sure the capital's fungible. And that means moving the capital around. Can you move it? And the more fungible your capital is, the more you can react to the market. And MGAs give so many benefits for that. Now, if you look at why some MGAs haven't performed, is due to they don't have some of the in-house skills. They have great underwriting, great distribution. They didn't necessarily have the support around actuary and portfolio management. They didn't have the oversight from the insurer, and we've learned some more things actually working in that relationships. Rather than oversight, let's make it more collegiate. Sometimes MGAs say, look, we haven't got all the answers. We've got distribution, we've got good underwriters, we've got good data. Mr. Insurer, just help us a little bit here. And so, because we all want that same outcome, and it's it's a phenomenally exciting place to be a good quality MGA, and that's one of the things we're seeing. And certainly, my clients, the Mulberry Risk client, our clients are, when they engage with us, they're making a statement to the insurer. We want to take a step towards improving the quality of our business. And that's a really good message, and we do everything we can to help them along that. Not saying we're perfect, but we really try to invest in our R&D to help do that. So we've got things like, we've got a large database of information that we can benchmark our MGAs against. We've got techniques and methodologies that really help shore them up to really demonstrate that they are a high caliber unit and worthy. And this is a really big different concept, worthy of the insurer, the owner of that capital, to lend their capital to the MGA to deliver a return.
I mean, is it just the UK that you're focusing on at the moment? Is there plans to kind of, or are there clients in other territories at the moment?
Yeah, we've got some US stuff, and we've got we're a little bit in Australia at the moment. And we're talking to North America. I think we've got some really good. We've got a lot of clients, and we're always open for more. But at the moment, some of our clients are growing at such a rapid rate because they've got the MGA model correct. They're delivering service. They're managing their underwriting. we're helping them manage their relationship with their capacity in forecasting loss ratios. We're helping improve their pricing, support their underwriting decisions. I mean, there's just a, I mean, one of our top clients, I mean, both of them actually, our top two clients in the MGA space, I think are growing at 50% during lockdown. I mean, they've just really accelerated, and they can implement things very quickly. So while your big insurers, and even some of your big insurers, and even some of the newer startups to the table, they're slow to move and take advantage of the changes in the market, take advantage of new technologies, and really adopt. So no, it's great. And and the people in the MGA world are a lot of fun.
Yeah,
they're much more entrepreneurial. They've got a bit of a distribution focus, but they also have a lot of pride because they're smaller businesses compared to an insurer. There's a lot more ownership there.
Yeah, of course. Yeah, I really like the model. I mean, I've been doing a lot this year on the reason I'm asked about America, because it's interesting that the capacity relationship is slightly different. They tend to commit for longer terms, whereas noticeably in the UK it sort of seems to be everything's under review every 12 months. And I thought that's, I don't know if that says anything about the kind of business culture in the UK, but it certainly seems more helpful to have a kind of longer term play in the US kind of way, because you've still got controls on that capital, you've still got performance, criteria on it, and it's not like it can't be pulled. It can be pulled if it's way off, but kind of having that longer term commitment makes it much easier to be effective, move quicker, whereas every 12 months knowing that your capacity could be pulled is quite I'm not sure I'd want to live on that knife edge, really.
That's one of the biggest issues our MGAs have. So we're working with a broker at the moment to try and get a solution in for our clients around that. Because even if you've got a rolling contract, binder agreement, an evergreen one, or you've got, and the many of the annual ones are because they're through Lloyd's. That's what drives it, and that drives the kind of London market behaviour. We want to try and we're trying to get a facility in place, and whether we can get it or not, I don't know, but which can almost give a guarantee that we put a capacity protector guarantee around this. Then if you're a capacity protector client as an MGA and you lose your capacity, then there's some capacity to come in, which will come in for a period of time whilst you get stuff fixed and find new capacity. Or so, because even with an evergreen, you've got 30 days notice often, or I mean, I don't know any other industry which would be happy with that relationship on something that can snap and just kill your business. I mean, there are other ways of mitigating it. You don't have just one carrier, you have multiple carriers.
Of course.
But multiple carriers only make sense when you're a certain size. I mean, but my view often, it depends on the class of business, but once you need to get up to sort of 5 to 10 million with one carrier, ideally. And the reason why you need to do that is because you need to focus on growing and building your business. Managing those carrier relationships, particularly in the early days, is really hard work. And every carrier you bring on will require a lot of focus. And in the end, you'll spend all your time managing carrier relationships and not focused on your business. So the best mitigation to losing your capacity is sometimes make sure you're not losing, make sure you're meeting your underwriting targets, but that's not always plain sailing. But and that's not always the reason why you lose capacity either. But it's to get 2-3 carriers on board, but then you need to be certain size. So there's a risk, there's always a trade-off, and we try to help our clients understand that strategy a bit and how they can mitigate it.
Certainly. I mean, that's certainly always the kind of barrier that I'm presented with. If people don't have a business plan that says 5 to 10 million on it, it's not big enough to be interesting for a lot of carriers anyway. That they're not willing to deploy the capital. It doesn't have the scale. But yeah, it's a constant challenge. So I'm interested that the way that you framed the business in providing services to MGAs more than an actuarial consultancy, for example. So what do you see down the line? You sort of hinted at something there. I think that's really interesting hearing that, actually, the sort of all that almost sort of capacity, I don't know what you would call it, kind of fail safe. It seems a really good service and idea.
Yeah, we're kind of sort of. I mean, we're still, it probably won't happen until early next year, but yeah, we call it a capacity protector guarantee.
Yeah.
And that we can give you some sort of warranty, because through working with us, we can see that you meet certain standards.
Yeah.
Additionally, around this, we also have our Mulberry minimum underwriting standards based heavily on Lloyd's, but adapted for MGAs.
Mm-hmm.
So we can help grade an MGA against those standards, help them identify areas which are critical. So again, moving the quality of this MGA up to make them a more robust business and more appealing to an insurer.
Mm.
The future, we just want to continue. We've got our pricing technology platform to go into MGAs.
Mm-hmm.
We and support them. What we see an MGA is really good at is distribution.
Yeah.
And getting efficient, strong distribution, and with the underwriting now surround that as well. But that's what we really see. So getting a well underwritten, strong distribution portal is what the MGA delivers to your big carrier, but also is the ability to be very agile in that, so they can reflect the changes in the market very, very quickly. A lot of the MGAs didn't really struggle with working from home in the lockdown. No. Almost overnight, they were able to work from home.
Yeah.
Whereas your Avivas really struggled, the RSAs, their customer service, their broker service levels dropped. And just because they're such big beasts. Whereas the MGAs are very agile, and they were able to maintain those customer service levels to their brokers and customers.
Yeah, it's interesting, isn't it? We're seeing the kind of rise in the sort of small business anyway. Obviously, COVID's kind of driven some of that, as like recently. I mean, people have had to be entrepreneurial, sadly, but I think we were starting to see that anyway. People were niching down, and even product lines. It's not enough to say, you do a broad product suite now. You have to go, right, we are the best at this very specific class of business. And we've identified a problem that we're going to deliver a solution to. How much of the kind of, I know you touched on the kind of insurtech world. We were having a conversation before this started about defining what on earth that means. But the kind of MGA insurtech play, do you think we're going to keep seeing more of that as the kind of appetite run out, or is that just like continuing in niche products versus niche technologies is just going to enhance the need for that?
Yeah. Okay. The areas where I've seen it work really well, and it's certainly our client who are just outstanding at this, is around digital distribution.
Yeah.
Really focusing on the customer journey and using tech to really make an outstandingly good customer journey. And that also means about measuring it. It means about, that's that whole ecosystem around that. Those are the ones which are being really successful. Where we haven't seen so much success are the insurtechs who are trying to come in and fix underwriting results. There are those who've had investment and it's kind of bubbling, really. It's and so that's a lot harder to demonstrate. And I think one of the challenges around that is sales is always quite instant, and you can take your cut out of the sales and you can grow. And whereas improving underwriting results is a lot harder to fully demonstrate your value.
Yeah.
Even though it's probably, for a lot of the insurers, is probably more important in a number of ways. But it's a lot more challenging. It's not simple. So yeah, and then there's insurtechs who's going to try and solve big problems, and the other ones which I think are interesting are the ones who are trying to just focus on little things. And there's one which I know that, you know, and in short, they're not a client. I'd love them to be a client, and they should be. Flood Flash. And with Flood Flash, the parametric, you know, that's an insurtech led thing. It's but it's combining technology with parametric insurance policy, which is just brilliant. There's no and Ola Jacob, who's there, who's a good friend of mine, and an outstanding individual. He tells this story about a client who got Flood Flash in. And I don't know if you know how Flood Flash works. You get this tube stuck outside your house or shop. And if the flood water goes up to a certain level, you get a fixed payout. So if you buy 0.5 meter flood level and you say, I want £10,000, they'll calculate the price of that and you say, yeah, I'll have that. So the policy conditions are so simple. There's no adjustment. Has it been triggered? Yes, here's your money. And it's quick. So I
like the idea of that being like a flood fruit machine. Like watching it go, oh, hey.
But what this also means is simplifies the whole idea of risk. And so what I saw, so the story that Ola tells me, and he may have changed this, and if I've got it wrong, Ola, I apologize. But he talks about the story of a shop that got Flood Flash installed, and then they bought, let's say, 50 centimeters trigger, and then they had a payout. Now, what this shop then did was they moved everything on their floor up 50 centimeters.
Right.
So the excess in the policy wasn't a financial amount. The excess in the policy was then a physical excess level. So this shop said, I am protected up to 0.5 meter. And so I really like that. I thought we're now putting excesses into physical things. We're encouraging a shopkeeper in this situation to make risk changes to their book. Now, there's loads of ways you can look at this. There could be other, you know, anti-selection and things, but just that one story, all of a sudden, to me, combine insurtech, new insurance policy and wording, plus just a really simple approach, a really good customer outcome. Who the customer now understands what the excess means. It means I move all my goods off the floor up 0.5 meter. And
that's in the same way that kind of I think health is being looked at, isn't it? If you take the NHS or even health insurance, the focus has always been on when something happens, we pay you some money, rather than sort of, you know, preventative measures. And a lot of that is about simplicity. So a lot of the sort of move on the health insurers to sort of go towards, you know, if you go to the gym 4 times a week, we'll make your payments reduced. You know, it's the same sort of, I mean, give me some rope there, but there's a similar sort of like pathway in that I think insurance is often overly complicated, is often too focused on kind of replacement or repayment. I use the analogy that I was burgled and in London, and you know, having worked in insurance for a long time, I knew the process worked, and I got paid out and it was fine. It's just a really long process, and actually I would have much preferred a kind of, just wanted it to be simpler, and I would have taken a hit financially on that to just kind of get on with my life. You know, it was just like, right, I've lost a load of stuff. If I had a sort of payment mechanism attributed to that, it'd be much better for me.
And I think you're right, and that's where the focus on the customer. That's why I think insurtech focusing on the customer journey, the customer experience, and driving it out of that, and that will drive changes in the underwriting, changes in. I mean, we're just doing our house insurance, and you know, and one of the questions, and we're doing it for a broker now, but one of the questions is, when was your house built? I was like, well, this part of it was built in 1600. You know, it was built between 1600 and 2010. You know, and it was kind of like, what do we put? And my wife was looking, she said, well, you work in insurance, what do we put? And I went, let's just tell the broker, we don't really, what does he want us to put? And so it's, you know, there are some really difficult questions. policy wordings are complicated because of, you know, if it's not excluded, then it's on risk in a way. And it's not the 90% of good people, it's just the people who are always trying to get one over the insurer, really. And that's why the policy. So there's a lot of work, but I think, in my view, the insurtechs who are really making success are the ones who are trying to focus on the customer experience and journey, and they'll figure out the underwriting behind that. So if you look at Lemonade, that's been their approach. Bought by Many, that's their approach. You know, you can. Zego was about the customer journey, and the outcome, and their customer was actually Deliveroo. That's where the guys came out of. And Deliveroo wanted to get more and more riders on, but they couldn't get the riders on the scooters because commercial insurance was too expensive. So they created the app, which integrated and made it easy for the riders, easy for Deliveroo, and they solved the problem for that customer experience. Like Bought by Many customer journey is just so nice and simple, and with a real focus on the customer and their pet owner and what they can do for the pets and make this experience better for them. Is it perfect? No, but the fact is that they actually talk about it, and that's what their focus is. So, you know, these are successful insurtechs, and I think the other ones are struggling because they just take more investment and more challenge to, and ultimately a lot of insurance is about the law of large numbers. You know, these are the claims that happen. If you allocate it over there, you're still going to get all these claims.
I was talking about that with I interviewed Marcus Schmalbach of RiskX and the parametric solution, and he said, you know, what he was talking about is some of these risks is when the law of large numbers doesn't apply, then it ceases to be insurance, or you know, if it's so expensive, for example. And there was a huge kind of focus on that. But the insurtech landscape is I see exactly the same things as you. You either are targeting a very specific niche and solving a very small, potentially small problem, or you're absolutely focused on the customer, which I think insurance has lost sight of. But one of my views that I've always had is that, you know, investments are obviously necessary to get you to a certain point, but you can take too much. And if you take too much, you're then putting yourself in the position that your niche, for example, may not be big enough to return on that investment. So you've kind of, you might have solved one small niche problem, which is your USP. If you take too much investment, if that USP isn't a big enough area to provide enough return, then you then start diluting your offering, and then you sort of get away from what the solution you were trying to do in the first place. And it's just a risk. But, you know, finding out what is the right amount, you know, because the contrary thing is to take investment without taking enough. What's the point? It's the most expensive equity you ever sell is those first investments. So
I think I don't know, you know, we haven't had investment at Mulberry, and that's been, it's apart from everything I've tried to scrape together and stick in, and you know, and we've raised debt and things like that. But and there's a part where, I mean, there's loads of stories, aren't there? Simon Sinek talks about why, and the Wright brothers, and going against basically the American government and all the money they had. One of there's a chap called Ian Atkinson who I came across, and he wrote the Financial Times book on business writing. He's a copywriter. Really highly recommend his books. And one of the books he writes is sort of 12 ideas on innovative or creative thinking. And he bases a lot of this on the stuff done by Edward de Bono. This is not his lecture, but but one of the things is about restrictions. So restrict yourself. So, and you can look at this in many areas where if you put constraints about what you can do. So if you think about BlackBerry's dominance in the phone market, and we always talk about the iPhone and how innovative it was, but almost it's like we want to maximize the screen. So if we maximize the screen, we throw away the keyboard. So how do we operate the phone without a keyboard? That's our constraints, and that's how almost that innovation. I'm not saying that is how it came about. That's kind of an example, but
no.
And sometimes I think, going back to your thing, sometimes the innovation comes when you're forced to have constraints, and constraints can be funding as well, because you've got to find the harder path. You can't just go, oh, we'll just go and buy that. We can just buy that. It's just much more. You have to fight a lot more, and you have to be a lot more creative to get to that solution, and work harder. And there's so I agree with you sometimes, but it comes to a point where the business doesn't need investment to really start flying once they've sorted out that business model. And I think, we've seen that in a couple of businesses which have hooked onto something, and you'll see in their early days they actually achieve so much. They have this small dynamic team, superstar team, who achieves so much. Okay, it's held together with sellotape and just about functioning. And actually they say, oh, we built this in 3 months, and they probably did. And then they get a big load of investment, and then it all kind of loses a bit of its way, because it's just got a bit too much investment.
Then they're spending on football tables and away days and
oh yeah, office space.
Exactly. We workspace you can't use. But look, David, I'm really conscious that I took up more of your time than I said I would, so we'll end it there. But thank you so much for your time. I really
enjoyed. A pleasure, Alex.
And where can so people can find you on the Mulberry Risk website? But if there are any actuaries listening and don't want to go through me, and they do want to go directly to David, is it approach you on LinkedIn? Have you got ads up on, or just
LinkedIn and mulberryrisk.com, and we're always happy, to help people in the market as well. We do have a masterclass series, and I need to pick that up again, but we do like to share a lot of stuff as well.
Great. Well, if you've got a link for that, I'll put it in the link notes to the video. But thank you very much for your time. Really appreciate it.
Pleasure, Alex. Cheers.